Thank you for listening to the Tortoise and the Hare Financial Podcast. My name is Jim Leo, partner of TVH Group, president of TVH Financial, and private wealth advisor at Raintree Financial Solutions. Have you ever wondered what would it be like to have $1 million? Well, in today's episode, we're going to go through some money moves to make in your 20s, 30s, and 40s. Before we get started, let's hear a word from my sponsor.
If I had $1 million.
I love the intro song by the Bare Naked Ladies, If I Had $1 Million. When that song came out over 20 years ago, I was in high school, and when you thought about having $1 million, it really seemed at the time like a lot of money. Nowadays, not so much. I also remember around the time I was working as a bank teller at one of the major banking institutions, and we had an RSP campaign, and there were signs all over the branch. Talk to us about how you could be a millionaire, how you can reach $1 million. And really all it was you'd sit down with a personal banking representative, and they would work out how much you'd have to save on a monthly basis at a specified rate of return in order to reach that magical number of $1 million at retirement. And a lot of people just couldn't reach it because they had other priorities, mortgage payments, debt, feeding their families, education expenses. So in this episode, I'm not going to be giving any fancy or special or private investment recommendations. There are no magical investments out there that can quickly make you $1 million. I am going to go through some moves that you could make. The earlier the better. So if you're someone who's younger in their 20s and 30s listening to this, some of these moves will help you get to your goal, whatever that goal is, financial goal. It's really following a philosophy and a process that will get you to where you need to get to. Now, if you're someone who's older and you feel that maybe it's just a little too late to make some of these moves, it's not. And not only that, you might have someone younger, you might have children that you might want to help go through some of these steps and put them in a much better financial situation that you might be in yourself. Many clients that I've worked with throughout the years, they've all learned about money from their parents. And some strategies are valid, and I could validate them for the clients. But there are some strategies that really worked well during the financial period that the parents were going through, but it doesn't necessarily work so well based on our current financial circumstances. There's a couple of examples of those. I've worked with clients who couldn't understand why their father and or mother had all their money literally in a mattress. And I would ask the question, when were they born? And typically those individuals who are stuffing money in their mattress lived through the Great Depression. And we've read about the Depression, but we haven't lived through that situation. And it's very difficult to say to someone who has lost a lot of money during the Great Depression when banks failed that it would never happen again. They lived it, they experienced it. So it's very difficult to change their minds. But what they went through the Depression, very different than what some of the baby boomer clients that I've worked with had gone through. And even now when I work with younger clients in their 20s and 30s, even 40s, they'll refer to some of the money moves that their parents would make and encourage their kids to do the exact same thing. And again, in some cases, it just doesn't apply. And I'll use the pay down of a mortgage as an example. This question comes up quite frequently. The parents will tell their kids to pay down their mortgage as quickly as possible. That should be their number one priority. And during the 80s, when the parents had a mortgage and they were paying 22 to 24% in interest to fund that mortgage, they were getting anywhere from 12 to 14% in GICs, government bonds. They probably were getting around 8 to 10% in a daily interest savings account. Interest rates on debt was very, very expensive. Rates of returns in the marketplace averaging around 7% per year up until that point in time. Real estate growth was again in the low single digits. So during that time, if you were faced with a 22% mortgage, I agree, it absolutely made sense in many cases to pay down that mortgage as aggressively as possible. Now, the one thing that you give up when paying down a mortgage is use and control of your money. But again, when you look at all the numbers, 22% is a significant cost. So it did make sense. But nowadays, in the last decade, even longer, interest rates on a mortgage have been really, really low. So if you have someone who's been paying 3%, 3.5% on average on a mortgage, now they're not going to get anywhere close to that in a GIC nowadays, and they're not going to get anything close to that in a daily interest savings account. But real estate's still compounding in parts of the country, specifically Toronto GTA, at 7-8% per year. So that's a pretty valid investment. Equity markets are still performing at a 7% average rate of return. There are other investment vehicles available where you could earn and grow your wealth by investing that money as opposed to paying down the mortgage at 3.5%. And as long as the funds are liquid and accessible, so if things change, you have access to the investments and you can pay down the mortgage if you feel like you need to. But once you make that payment, that extra payment on your mortgage, again, you've given up use and control of your money. So there's an example of another money move that nowadays really doesn't apply like it did back in the early 80s. But let's talk about this article that I'm referring to. It's called Money Moves to Make in Your 20s, 30s, and 40s. I've included the link to this article as well. This is written by Mint Life. And I'm going to go through some of the points that they make. Some I don't agree with. Some might even be a little bit controversial, but I'm just going to go ahead and provide my thoughts. And my opinions and my thoughts are based on 30 years of experience in the financial services industry, working with clients, from the early ages in their 20s to 30s, all the way through to retirement, and all the way through to, unfortunately, when they're no longer on this earth. So I've worked with a wide range of individuals. So a lot of what I'm going to share with you today is based on my own personal experience in working with clients. And in saying that, I've had clients come to me and have said, they'd wish that they met me earlier to have made some of these moves that they were not aware of because they felt that they would be in a much better situation. And I appreciate people sharing that with me. And what I would suggest to you, if you are a client who has worked with me and you're happy with our relationship and how things have worked out for you, I'd encourage you to go to my podcast page, which is anchor.fm/TVH Financial. Now, when you go there, you'll see there's a little button called Message. If you hit the plus button, it'll allow you to do a recording. And you can record your thoughts, how I might have helped you, whatever you like. And I may or may not use that recording in future podcasts. Now, with the Anchor.fm app, it will ask you to open up a free account. There's no credit card required or anything like that. It just allows you to open up that account so that way I can actually see who sent that message to me. So I would encourage you to do that. Another thing that we're doing as well, which would be very helpful, is we are offering clients of ours to provide a video testimony. Now, the way to do that is I would send you, again, a link, and you can record a video testimony using your cell phone, your tablet, your computer, as long as you have a webcam or a camera on it. And there's no cost, again, to doing that. So if you're interested in doing any one of those, please let me know. I would appreciate it. So let's talk about money moves and starting in your 20s and some of the things you should do in your 20s to get started on your financial journey. And the first one, which is what I find to be a little controversial, is learn how to budget. Now, I don't think budgeting is wrong or people shouldn't do it. what I have found is that most of the time, budgeting just doesn't work for individuals. They start off on the right foot, they feel good about themselves, and then many people tend to fall off that wagon. They find it very difficult to follow a budget. I've said it before, it's very similar to dieting, which I've been on diets myself. You feel good the first couple of months, you feel good about tracking everything, but then you get tired of it. And sometimes you put yourself in a much worse situation than when you first started off on that diet or budget. What I encourage people to do, instead of budgeting, if again you feel that's going to be challenging for you, is to go through an exercise of a month, maybe 2 months, of tracking everything you spend. You can either write it down on a piece of paper, you can use an Excel spreadsheet. Mint actually offers a free program that you can use, and then see where your money is going. The awareness of what you're spending your money on might alter you to change how you're spending your money. If you're spending $2,000 a year on lattes, for example, there's nothing wrong with that. But if you're finding that things are a little bit tight, maybe you adjust the amount of lattes that you have. Maybe you make more of them at home as opposed to going to Starbucks, for example. So I feel that if you are aware of what you're spending and what you're bringing in, that'll open up your eyes and will assist you in terms of how you should spend some of your money. Now, in your early 20s, it talks about paying off debt. And debt isn't all bad. If you have debt where you can claim the interest expense, that's good debt. If it's debt for education purposes, that's good debt because you're working towards getting a degree, which will help you increase your income potential, which is fantastic. The type of debt you should consider paying off in your 20s is bad debt, specifically if it's credit card debt. Credit card debt at 22% is significant. So that's something you should try to do is pay off your debt, pay it off in time as well, because you do want to maintain a strong credit rating. Now, you also, if you're fortunate enough to live with your parents during your 20s, build a cash cushion. If that's a position that you're in, build yourself a nice cash cushion. The cash cushion will help you establish an emergency fund. It also could be used as a down payment on a property. So that's something else in your 20s you should really try to focus on, is just building cash. And when we say build cash, don't put every single dollar into, a high risk investment. I've seen people do that as well in the past. When we're referring to an emergency fund, it's a fund that's easily accessible, quickly accessible, and you don't have to worry about market risk. So a daily interest savings account, a tax-free savings account, those are a few examples of where you should put your funds that are used for emergency purposes. You should also understand credit. And again, if you go to Mint's website, there are some tools there for you where they teach you about credit. Having a good credit score is extremely important in life as you get older. It helps you qualify for better rates on things like a mortgage, for example. If you need to purchase a vehicle, again, if you have good credit, you'll get preferred rates. So understand how credit works, what impacts your credit, both in a positive and negative way. So those are things that in your 20s you should consider pursuing from a financial perspective. Now, once you get into your 30s, things change a little bit. Now, the first point that the blog post makes is, you should invest for retirement. If you could do it before then, that'd be fantastic because dollar cost averaging will come into play, and you'll be in a much better financial situation in retirement, closer to that $1 million net worth goal if you start sooner. However, if you're not able to, try to get into that habit in your 30s. And when I say get into the habit, don't make it an annual contribution. Everyone goes crazy in January, February, making RSP contributions. Try to build that into your plan every single month to systematically create a forced savings plan. The first few months might seem a little bit difficult, but eventually, I promise you, you'll get comfortable with it, and you won't miss the money, and you'll feel good about actually receiving investment statements showing you a positive cash value. So you can start looking at investing for retirement in your 30s. There's different rates that people talk about in terms of contribution amounts, anywhere from 10% according to the Wealthy Barber. I think now we're probably creeping towards that 15% of your income should go into some form of retirement investment account. If you're having a difficult figuring that out, reach out to me and I can help you walk you through that process. Now, the next thing it suggests is to buy your first home. Again, if you can do it sooner, that'd be fantastic. But in your 30s, you want to try to purchase a piece of real estate that you own. And the reason for that is when you rent, if you're in a situation that you rent, and if you're paying, call it $1,000 a month in rent, well, that's $12,000 a year. But you'll never get that money back. Not by way of, if you walk away from the lease, you're never going to see a dime back. At least when you do have a mortgage in your own real estate, that is a form of forced savings because you are making a mortgage payment, which is paying down part of your principal on your mortgage. But there's also hopefully an increase in value in your asset. And I've personally worked with clients who started investing in real estate in their 20s. They were able to do it. They started off small. And I can honestly say to you that they really didn't need my help in terms of planning for retirement because they put themselves in such a great financial situation that if they chose to retire in 42, 45, they would be able to based on just their real estate holdings alone. So real estate is very important, and you should try to do that sooner. But in your 30s, it's probably a good time to do it. Now, here's one, and this one people don't really think about it, and that is to be covered under must-have insurance policies. The younger you are, the chances are you haven't had any major health hiccups or issues to deal with, which means it's easier to qualify for insurance coverage. And also because you're younger, the premiums are lower. Now, when I work with young clients when they're single, they don't really, they're not concerned about dying and leaving debt or anything of that nature through the estate. They're more concerned about getting sick while they're alive and not being able to cover their financial obligations. So you should look at disability insurance. You should consider critical illness insurance. Critical illness insurance, I've personally had to claim on my policy, and that made the difference between having to cash out investments that are intended for the future or keeping those intact and having the insurance company cover my expenses for a period of time. So you should start thinking about these things when you're younger as opposed to when you're older. I have clients who come to me now in their 50s and 60s wanting coverage, and they're paying a lot more, and it's challenging for some of them to get the coverage because, they have experienced some medical issues throughout their life. Now, another one here is invest in self-care and well-being. I don't think this is really something that anyone really considered 20 years ago, 30 years ago, even as recent as 10 years ago. But now mental health is, we understand it's very important. So you should invest in taking care of yourself physically, mentally, because if you, again, learn these things now, you take them on with you for the rest of your life. So those are some of the things that you should start to consider in your 30s. Now let's talk about the 40s. Well, let's revisit your college savings goal. So if you have young children and you're putting money aside for their education, let's make sure you're on track. So let's revisit the savings goal. Part of the other consideration too is the cost of education has increased significantly. So we want to make sure that we're on track to be able to fund education costs for your children. Then it suggests to get aggressive with retirement planning. So, at that point in time, if you're someone who owns a home, and are looking at building wealth, there are multiple ways to do it: real estate, insurance programs, traditional investments. You need to try to get a little more aggressive and make sure that you are close to reaching your goal. Here's the thing about retirement planning: many people don't do it. The people that do kind of punch in some numbers and they receive a report and think, okay, I'm fine now, and then they never really review it ever again. There's no progress report. They don't really ever look back to see if they are on target, if they need to make any adjustments. So it's very important that you do become aggressive with your retirement planning, but also having an understanding of if you're going to achieve the goal that you've set out for yourself, and to perform a regular progress report to make sure that you are on track. Building more wealth. Well, again, sometimes it's easier said than done, but one way that people have built more wealth is by becoming landlords, owning rental properties. So that's one way of doing it, or following a philosophy and a process to continue on building their investment portfolios, not dealing with knee-jerk reactions based on what's happening over a very short period of time. So trying to build more wealth is very important, because here's the thing: the older you get, the less time you have to build that accumulation of accounts. So focus on that in your 40s. Revisit your insurance coverage. Things change. So what may have made sense for you in your 30s, might not make sense for you in your 40s, or you might need more of it, or maybe you need less of it. So you should revisit your insurance coverage, and that's really no different than the progress report. The progress report shouldn't just be based on what your retirement goals are. It should also be, based on, your coverage and what you have. So work with a financial advisor to assist you with that. And the final thing in your 40s that you should start considering, and again, some of these you should have done sooner if you've started a family, if you're married, but consider estate planning. You should have wills, trusts, power of attorneys in place. You should have it written down what your intentions or your wishes are if you're in a situation where medically you can't make decisions for yourself. If you prematurely pass away, what happens to your assets? If it's not written down, the government will decide what happens, and that's the last thing that you want to have happen to you. I'll use me as an example. I've been in the industry for many years. When my wife and I started our family and we were expecting Serena, I was approached by someone in the family who helped out with establishing wills and powers of attorneys. And of course, she asked me if I had one in place. And we said, well, eventually we're going to work on it. And she said, you need to really work on it sooner rather than later. I really didn't feel like I was in much of a rush until she asked me the question, well, you and Carol travel a lot. What if something were to happen to the two of you? Who would then take care of Serena? And Carol and I kind of looked at each other, and she's like, well, if it's not written down, the government is going to decide that for you. Do you want the government to decide who will take care of your daughter if you're no longer here? And of course, the answer was no. So we quickly drafted up our wills and our powers of attorney. So if it's something that you haven't done, and many clients that I speak with, either they haven't put one in place when they should, or they had 10, 15 years ago, and again, a lot has changed. So a review might be necessary. If you don't have someone who can help you with setting up the wills and powers of attorneys, or if you don't have someone who can review them for you, reach out to me because I can refer you to my partner, Sonia, and she would be more than happy to assist you. So that is the end of this week's podcast. Again, I wasn't looking at providing any special secret investment advice. Really, the important thing for everybody, if you want to achieve success, and here's the thing, no one is 100% right. There's no financial advisor out there that's 100% right all the time. There's no investment guru that's 100% right all the time. But if you follow certain steps, if you believe in a philosophy, if you follow a process and you revisit your plan, you will be right most of the time. You will survive a lot of the volatility that might be happening out there in the world. The important thing is to follow the process, advice, and to put a plan. So thank you for listening. Once again, I'm Jim Leo, partner of TVH Group, president of TVH Financial, and private wealth advisor at Raintree Financial Solutions. If you'd like to explore any of these with me, please reach out to me at 647-727-4668, or you can email us at financial@tvhgroup.ca.
If I had $1 million, if I